You tap a titanium card against a glowing terminal. Your phone unlocks with a glance. And in less than 2 seconds, your bank decides whether you can afford lunch. Behind the glass, that single tap triggers a frantic conversation. The merchant pings a payment processor. The processor hits a card network. The network asks your bank, does this account exist? Is the card valid? Is there enough available credit? The answer races back through the chain before the cashier even prints the receipt. Eventually, these modern signals must terminate at the system of record, the central authoritative database where the institution decides what money actually exists. Beneath the cloud services and the biometric security, your money is likely encountering a programming language created in 1959. This code predates the first human footprints on the moon by a decade. To understand how modern capital actually moves, we have to look past the apps and examine the ancient technological bedrock holding the entire structure up. That bedrock is COBOL, the common business-oriented language. It was never intended for physics simulations or spaceflight. It was engineered for the relentless, rule-heavy, repetitive work of managing accounts, payrolls, and daily transactions. It was built to resemble basic English. A program can contain commands like add interest to balance, or display account total. It is a specialized hammer designed for a very specific kind of logic. But the code does not sit untouched in a vault. It is constantly patched, expanded, and modified to keep up with the world. Every new financial regulation and every bank merger bolts another layer of complexity onto the core. Over 60 years, these edge case exceptions pile up, turning a once simple program into a sprawling, uncharted digital city. The real value is the accumulated history of millions of decisions buried inside. This makes replacing the software an exercise in digital archaeology rather than a standard IT upgrade. Converting this logic into Python or Java sounds like a straightforward technical solution, but banking lacks the safety nets of standard software development. A social media company can test a new update on 5% of its users and roll it back if it crashes. A bank cannot beta test 5% of its customers' balances or risk misplacing a wire transfer. In finance, absolute predictability is the primary requirement. The stakes are clearest at the Federal Reserve. This tracks Fedwire. Every business day, it processes an average of 869,000 transfers. The total value moving in 24 hours is roughly $4.6 trillion. When modernized in 2025, the message formats changed, but the underlying production engine remained completely untouched. In a system moving trillions of dollars, the risks of starting from scratch transform a technical plan into a systemic threat model. Banks manage this risk by modernizing in layers. They wrap their original transaction engines in digital translators called APIs, allowing a modern app to communicate with a 60-year-old mainframe. In practice, it is a process that resembles swapping the engines of an airplane while it remains in flight. This strategy works until the humans who understand the core logic begin to disappear. The original programmers are retiring, and the institutional knowledge of how these systems actually function is leaving with them. The danger is not that old code is inherently broken. The risk comes from the shrinking expertise, the incomplete documentation, and the forgotten dependencies buried deep inside the machine. This creates a trap. Replace the foundation too quickly, and you lose decades of proven reliability. Keep it, and the knowledge required to maintain it eventually dies off. The oldest code in the bank acts as its memory, holding every correction and rule that keeps the financial system functioning. Every time your phone approves a payment in milliseconds, that futuristic interface is standing on the survival of the past.